Welcome to Mayor Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayor Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners, and thank you for joining us today. Today's topic is what to expect in banking in 2023. The end of 2022 saw a few noteworthy proposals and other actions by the U.S. banking regulators, but it's more likely that we will see additional proposals in the first half of this year. Today, we will discuss how these actions are relevant to the banking industry and how they may impact you and your institution. My name is Jeff Taft, and I'm a partner in the Mayor Brown's Financial Services Regulatory and Enforcement Practice Group. My co-presenter today is Matt Bisanz. He is also a partner in our Financial Services Regulatory and Enforcement Group. I'm going to cover three topics today: digital assets, Federal Reserve master account litigation, and FDIC signage and advertising requirements. Let me start with digital assets. And I'll start by stating the obvious. Banking organizations remain interested in engaging in digital asset activities, despite the recent events. Much of the recent activity has involved banks partnering with digital asset companies to make products available to banks' customers. Some banks may be delaying initiatives because of uncertainty in applying the SEC's SAB 121, including whether it will be adopted by the U.S. banking regulators. U.S. regulators indicated in November 2021 that they would issue guidance throughout 2022 on whether specific digital asset activities are permissible for banking organizations. To date, no further public guidance on permissible activities has been issued. The OCC and the FBRB have implied that certain activities may not be permissible, but have not issued comprehensive guidance. It's unclear at this point whether such guidance is forthcoming or whether the regulators will operate in a much more patchwork fashion with respect to particular assets and particular activities. The Basel Committee recently finalized standards for prudential regulation of bank exposures to digital assets. This development obviously could have an impact on the US and other countries as they regulate digital activities and adopt Basel standards. Insured state banks may engage only in activities that are permitted under state and federal law that are permissible for national banks. The OCC has recognized that national banks may engage in certain activities, such as custody, but subject to certain prior approval and risk management guidance. The OCC has stated in its recent approval order that it's reviewing the permissibility of tokenized deposits, for example. In April 2022 and August 2022, the FDIC and the FRB issued guidance requiring institutions they regulate to provide prior notice to the agency of any digital asset activities. The guidance was issued under Safety and Soundness Authority, but also mentions customer protection and financial stability concerns. The guidance appears to be designed to maintain parity amongst federally regulated banking organizations, such that there's no race to the bottom amongst chartered institutions based upon their charter or their regulator. This may take several months for regulators to process a notice, and that's been our experience with many of the recent notices that have been filed. It's also unclear how prudential regulators' review relates to FINRA's approval requirements for broker-dealers engaged in digital asset activities. In January 2022, the FRB issued a report on the benefits and risks presented by a potential U.S. central bank digital currency, the CBDC. Requested public comment on various questions and comments were due in May 2022. The agencies appear to be a long way off from deciding on whether to issue a U.S. CBDC, let alone issuing one. Some agency principals appear to be opposed to the concept, and some view it as necessary for the U.S. to keep up with other countries. This is an open issue that remains to be seen as to whether this will get traction in the coming year. Having covered digital assets, let me move now to the Fed master account litigation. Federal Reserve banks, as you may know, provide services to depository institutions such as collecting checks and transferring funds. Depository institutions, including insured banks and insured credit unions, have access to these services typically. Depository institutions may request the Fed open a master account with one of the Federal Reserve banks or rely on another institution to settle transactions on their behalf. The Fed will review and decide on each request for services for a master account. While master accounts have existed for over 75 years, it was not until the last few years that the topic has made its way into mainstream discussion. Like many of the Federal Reserve operations, the review process for obtaining such accounts and the identification of the holders of such account is somewhat shrouded in secrecy. Some of the discussions recently around eligibility and potential risks of the financial services system and some of the recent litigation have provided further insight onto this area upon which very few have seen or understood in the past. In fact, in my 30 years of practice, I do not recall much discussion for the first 25 years of that regarding master accounts. And now it seems like every week there's some discussion as to whether a bank with a novel charter has any possibility of getting a master account with the Fed and what that would entail. A lot of the public awareness around master accounts, I think, has come from the litigation that was filed by Custodia Bank. Custodia Bank is an uninsured Wyoming depository institution that was founded in 2020. It's chartered as a special purpose depository institution designed to connect digital asset companies to the US payment system. While that seems like a very good chartering mantra, it may not be the kind of things that the regulators want to read when deciding whether to allow somebody access to the payment system or not. Custodia applied for a master account with the Kansas City Federal Reserve Bank in 2020. Custodia also applied to become a member of the Federal Reserve System in 2021. As of June 2022, neither the Federal Reserve of Kansas City, Bank of Kansas City nor the Federal Reserve had issued a decision regarding Custodia's application. As a result, Custodia felt necessary to file a lawsuit against the Kansas City Fed and the Federal Reserve for failing to process their application in a timely manner, or in any manner at all, for that matter. The claims raised by Custodia involved the processing, and the delay in processing was unlawful. It was unfair. It violated the Administrative Procedures Act, and perhaps even violated the U.S. Constitution for not allowing any sort of due process or any sort of rights with respect to obtaining a license. Both parties requested that the court dismiss the case, and the court has been considering whether to grant or dismiss certain parts of the lawsuit. To date, the lawsuit continues. Custodia was not granted a master account by the court, nor was its complaint dismissed completely by the court. The parties are going through the litigation process right now. There were motions that were denied in part and approved in part in November. And in December, the court denied Custodia's motion for a default judgment and a master account. Most likely, this litigation will continue throughout 2023 and perhaps even into 2024. Also last year, the Fed issued guidance in August regarding the Federal Reserve's use and guidance when evaluating requests for master accounts. At the heart of the guidelines issued by the Fed is basically a three-tier review framework, depending upon the type of depository institution. For example, whether it's a federally chartered bank, whether it's a member of the Federal Reserve System, whether it's regulation of its parent, and bank is done at the federal level, whether it's done at the state level. All of these things determine what level of scrutiny the Fed will put the application through. Obviously, your traditional depository institutions tend to fall within the Tier 1 category, and they easily get access typically to a master account. Where uninsured state, trust companies, and others without any sort of federal regulation or oversight oftentimes will find themselves in Tier 3 with a much more difficult application process. Also in November of last year, the Fed published a proposal by which it would issue periodic lists of depository institutions with master accounts. Comments on that proposal were due January 17th. This list would not include pending applications or rejected applications, but rather a list of those depository institutions with master accounts. This was something that the Fed had done for decades, but stopped probably 10 or 20 years ago. While the litigation involves just one state trust company litigating against the Fed, the results will obviously have an impact on a number of other institutions. To the extent that Custodia is successful in obtaining a master account, or at least getting the Fed to review its application, other fintechs and other non-traditional banks with novel charters perhaps will also hope to get master accounts. The ramifications, obviously, of them getting master accounts could have serious, significant consequences for those who participate in the system. If one of these companies, for example, were to fail or be unable to meet its obligations from a payment standpoint and couldn't settle its obligations, it could have a ripple effect throughout the financial services system and could have effects on the settlement of payment by other institutions who rely on the Fed systems. Now we move on to the FDIC's advertising rules and their signage proposal. The Federal Deposit Insurance Act prohibits any person from misusing the name or logo of the FDIC, engaging in any false advertising, or making any known misrepresentations about deposit insurance. None of these things should surprise anybody. These are all common sense things, and I don't think anybody thought that one could misrepresent deposit insurance or misuse the logo of the FDIC. Nevertheless, given what's been going on, the FDIC obviously wanted to clarify some of the rules around advertising. It appears as though in the last couple of years, in 2019 and 2020, the FDIC had reported 165 instances of potential misuse of the name. Seems like an extremely high number, but I have no reason to believe that the FDIC isn't adequately and accurately keeping track of these types of complaints. So obviously there is some, misrepresentations perhaps going on. The final rule provides several illustrative examples of the types of prohibitive conduct. One indicates, for example, that a person must identify the specific bank or banks at which a consumer's deposits may be placed to avoid making a material omission. So obviously this is the view that the consumer has to know who is holding their deposit so that they're able to evaluate the deposit insurance coverage in light of other deposits they may have with that institution. And it also obviously stops people from just making the claim, for example, that your deposits are FDIC insured through some sort of pass-through coverage, but not mentioning a particular institution or having a particular institution that they are working with. In May 2022, the CFPB and the OCC also got into the game here. The CFPB issued a circular in connection with the FDIC rule, noting that anybody who violates the FDIC's rule would also be taking part in an unfair or deceptive act or practice under the Consumer Financial Protection Act. So therefore, if you're somebody who is either a covered party or a service provider or a covered party, you could be subject to a CFPB enforcement action for making misstatements about the availability or about the amount of deposit insurance that may be available to your customers. The CFPB indicated that it's concerned with representations about new financial products or services, especially those involving new technologies such as digital assets. The OCC also issued a similar statement noting its concerns with representations by digital firms and fintechs that are now covered by the FDIC rule. There's clearly a concern, obviously, out there that consumers do not understand what is FDIC insured and what's not. And by presenting to the consumer that something may be FDIC insured, it obviously could have an impact on the decision-making of the consumer, which to invest in that product, to purchase that product, to put their money with somebody. So obviously, the OCC, the FDIC, and the CFPB believe this to be an issue. And obviously, I think what subsequently has happened to their guidance in some ways, justifies what they were concerned about. So, for example, in July of 2022, the FDIC and the FRB issued a cease and desist letter to a cryptocurrency company that they allege made false and misleading statements regarding its FDIC deposit insurance status. The cryptocurrency company is now in Chapter 7 proceedings, and its customers are left to determine whether they have any protections from the FDIC or from the FDIA with respect to their assets that were supposedly left with a bank. The FDIC also issued guidance to address certain misrepresentations about deposit insurance that it believes have been made by some other cryptocurrency companies. It also provides that these cryptocurrency companies and their bank partners should take care to manage the risks. Obviously, these rules don't just apply to banks, they apply to others. They apply to fintechs and these other companies. And those companies can be subject to actions by either the CFPB or the FDIC for these types of misstatements. Finally, in December 2022, the FDIC proposed to revise its regulations on the use of FDIC sign and advertising requirements related to deposit insurance coverage. This addresses physical and electronic signage, bank websites, web-based applications, mobile applications, and the like. And it requires banks to establish and maintain written policies and procedures related to their signage and advertising requirements. These requirements are highly prescriptive depending upon the method for which the advertisements have been displayed. So, for example, you may have to have rotating displays on an app, or on some sort of banner page on a website, you may have to have rotating displays in order to comply with the requirements. There are also additional examples of prohibition against misrepresentations to cover certain acts by non-banks. This is obviously focused on cryptocurrency companies, but also other types of fintechs who may be associated with deposit products or helping people qualify for deposit products that may in fact be eligible for deposit insurance. Comments on this proposal are due by February 21st, 2023. While the proposal has broader implications, it certainly will focus attention on crypto and bank partner relationships. Whether a product is subject to deposit insurance is an important fact for consumers, and false or misleading statements in this regard are likely to be going to have an impact on consumer behavior and likely going to draw the attention of the regulators. Matt, let me turn it over to you now.
Great. Thank you, Jeff. I'm going to be covering three topics at a little higher level than what Jeff covered because they are important, but I think that they are not as topical, or as there's not as much change going on with them. And so the first topic is novel bank charters, which Jeff alluded to, that people are trying to get novel bank charters to get Fed Master account access to engage in digital asset technologies. But novel bank charters as a general category progress has slowed since the beginning of the Biden administration, and even more recently. That prior to that, we saw several chartering initiatives announced at the federal level, say the Special Purpose National Bank Charter. We saw some ILCs getting through at the FDIC, and Wyoming had authorized its Special Purpose Depository Institutions. There are other states considering similar initiatives. The OCCs has mostly ground to a halt. They have completed a review. There were some fintechs that acquired full service national banks and therefore became subject to the Bank Holding Company Act or the control framework. But as a general matter, novel charter arrangements that maybe did not trigger the Bank Holding Company Act, those have not made much progress at the OCC. Some were withdrawn or converted to full service. As Jeff mentioned, the Fed did finalize its standards to evaluate account access requirements, but to the best of our knowledge, has not granted any to fintechs or other banks with novel charter arrangements. That if that proposal that Jeff mentioned for the list goes forward, maybe we'll see someone on there that we didn't know about. But the general tone has been that there's not been much progress. Some states have moved forward with special purpose bank charters. Nebraska has its digital asset depository institution charter. Illinois is considering a proposed charter for digital asset trust companies, but there's been no final action. And in some ways, it's difficult because you have things like the SEC, which has explicitly declined to endorse Wyoming's interpretation of a bank for the securities laws. You have states that generally will not give exemptions to money transmitter licenses to certain types of uninsured trust companies. And so while there are some benefits to getting an uninsured state bank charter, they are not as widespread as, say, if you got an ILC company or some kind of national trust bank where you could get benefits of federal preemption. The second topic I will touch on is climate risk management. This is a fascinating topic in terms of it's completely new. In the last 2 or 3 years, it has come from scratch, and now there are regulators deeply engaged with dedicated offices on bank climate risk management. The current status is the 3 federal regulators have proposed substantially similar principles for how they will expect banks to manage climate-related financial risks. Each has gone to extreme efforts to say that they do not believe banking regulators should engage in climate policy. They are not telling banks whom they should lend to or not lend to. They are not setting the prices of loans. They are only expecting banks to prudently manage the risks associated with climate change. NYDFS has also proposed its own guidance for banks and mortgage institutions on climate-related financial risks. The NYDFS guidance has been a little bit more tinged with policy-making tones. There were some statements in there about the risks of relying on insurance for climate risk management efforts that indicated banks may want to consider if they won't be able to rely on insurance. And I think some of us found that to be a surprise, because there are plenty of regulators who have been saying, well, look, get insurance for these specific risks. There's cyber insurance that many banks have. It still is the policy of the federal government to mandate flood insurance, and so the New York position on insurance for climate related financial risks has been somewhat of a surprise, but I think it is indicative of the more charged views of this topic at the state level. Most recently, the Federal Reserve launched a scenario analysis exercise to look at climate scenarios on how the 6 largest banks would perform under various scenarios. It's released this week a 52-page set of instructions on how those analysis will be conducted. It's focused on risk management practices. Again, this sidesteps the political footballs of quantification. It also sidesteps the issue of long tail risk, that while climate change is happening and will have a long-term effect on the planet, it is hard to measure that over the period of a credit card that maybe revolves monthly, or a car loan that's a 7-year car loan. That how do you manage the climate implications of that? And so by focusing on this risk management practices as a part of scenario analysis, the Fed is really trying to ground itself in something that it has the expertise to manage and will minimize congressional blowback. Finally, the Basel Committee, who really isn't a regulator in the US, they finalized principles for managing climate-related financial risks. These, it looks like, will broadly align with US efforts on governance and risk management, but some recent FAQs out of the Basel Committee appear to diverge from US regulators' plans. That they talk about how to integrate climate risk into the existing capital and liquidity requirements. And this would begin to define specific obligations for banks in a way that, again, Treasury Secretary Janet Yellen recently said probably is something that's a long way off for US banks, if ever. So what we can expect is to see more guidance on this topic, more regulator questions, and increased expectations for risk management. In the final couple of minutes I have, I'll touch on something that will be a big issue this year, but we don't know how it will be a big issue, and that is regulatory capital. That we know that the Basel Committee expected the member jurisdictions, the 27 member jurisdictions, to implement its 2017 revisions by the end of 2022. The U.S. did not meet that deadline. The U.S. regulators have indicated they would like to have final rules in place by January 1 of 2024 so that they can become effective on January 1 of 2025. There also is the most recent OMB regulatory agenda saying we can expect a proposal in March of this year. I think Jeff and I both think that's highly optimistic, given that that date has slipped in every regulatory agenda for probably more than the last year. This is driven by some of the structural issues that U.S. regulators are confronting, like the Dodd-Frank Act prohibition on using external ratings, which puts U.S. banks at a structural disadvantage for the cost of capital for certain types of corporate loans and other exposures. There are issues with the leverage ratio and the way that U.S. central bank reserves and government reserves happen, and it can be resolved by the U.S. regulators on the capital side, but that creates huge primary dealer issues for the Treasury Department. And so I think the U.S. regulators are trying to find a way to implement the revisions in a way that does not create problems for the primary dealer market. And finally, there's just generally the length of these, that the 2013 revisions, the last time this was visited by the U.S. regulators, were over 1,000 pages. And so when you have an interagency rulemaking with the constant changing cast of agency principles, and it's over 1,000 pages, that's why we've seen this delay. And hopefully we'll see something by March. But again, this is going to take up a lot of people's bandwidth once it comes out. And so hopefully sooner the better. Those are my topics. Again, not as interesting or advanced as Jeff's, but things that we are following this year. And there certainly will be other topics that we didn't discuss today, things like Bank Merger Act policy, things like the beneficial ownership implementation by FinCEN. And certainly feel free to reach out to us if there are topics where you're like, why didn't you guys address that? We're always happy to chat about things and learn more from our listeners. And I want to thank our listeners. We know your time is valuable and we appreciate your listenership to our podcast. This is a great program that we've been doing for many years, and we know that it's something that many people find valuable. Hopefully you found it valuable.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayer Brown audio programming, visit mayerbrown.com/podcasts. Thanks for listening.